Welcome back to another weekly episode, guys. So, today's episode has a lot to do with getting better with stock patterns and how do you trade it across the time frames. See, there is a notion in books that a particular time frame only works maybe on a daily time frame or a weekly time frame. That is actually not true. These patterns work across time frames provided you have the time to go through the details during the day. I would still advise that if you're new at stock market trading or have about 3-4 years of experience, you should be sticking to only three time frames. The first is daily, the second is weekly, the third is monthly. If you do analysis of these three time frames, you'll get a better idea as to how to get better at trading. And I've covered these time frame related topics in detail. I'll just link that particular video so that you can watch that also in case you've missed it. Now, whatever I covered today, it's divided into two parts. The first part is what Mark Minervini teaches in his books with respect to the patterns. There are three main patterns that I usually trade in the market. The second part is where I'll show you some examples from his book, and then I'll show you these examples playing out in the last 1 week. So I won't take up any stock that I've been discussing since March, that is more my holdings, because those things have already played out. There were a lot of things that were happening in the last 7 odd days also. And had you been aware of these simple things, how to structure your trades, you would have gotten some amazing opportunities. So first, I'll start with what Mark has taught in his book. There are three main broad points that he discusses. Number one, there is a right time and a wrong time to buy stocks. Number two, stocks with super performance potential are identifiable before they increase dramatically in price. And number three, by correctly investing in these stocks, it is possible to build a small amount of capital into a fortune in a relatively short period. So for those of you, and I feel majority of traders don't have a lot of capital at their disposal. Yes, by following these patterns on the right time frame at the right time, you can amass a lot of fortune. But it takes a lot of time. Mark Minervini today is close to, I think, 60 years. So he's been doing this for the last 30, 40 years. So whatever his account size was in the 90s, today it is mega multifold of that in 2023. But it has taken him a lot of years. Stock market is not what you see on social media. Today I'm making 20 lakhs, 50 lakhs, 1 crore trade. All this is nonsense. It takes a lot of time for you to grow even a small account. Let's say you have a 10 lakh account. It will take you at least 10 years to reach in crores. That is the truth about stock market. You have to embrace this. If you do, then you'll be making relatively fewer poor decisions. So what is his concept? Don't go by what is shown in this book. Understand the way price is structured in the market. What is happening here? A trend that is already established, then price goes into consolidation and then it breaks out again. I'll give you a real-time example of this also. So what is essentially happening? There are three stages here. One, existing trend. Number two, consolidation. And number three, again, an entry point, that is a breakout. So up move, pause, and again a breakout in the market, right? So when you're climbing a hill, a real life example, when you're trekking, is it that you go from point A to point B in just 1 hour at one stretch? No. In between, you take a pause. That is how stock markets work. Once the trend is in motion, a strong trend is in play, it will give you opportunity again here. I'll show you with one stock and with what index also that played out this week. By the way, this week I don't have a nifty video for you, but I've put out two very interesting videos. Number one here, number two there. A lot of you don't get this end screen video pop-up. That is because you're using a pop-up blocker or those kind of things. So just either try it on an app. You'll get the relevant video. So keep an eye. There are two very interesting videos I've put out that would be very helpful for you in current times. So the first pattern that I trade is a cup and handle pattern. A cup and handle pattern is something, it's a classic technical analysis pattern. It is not a pattern of Mark Minervini, but essentially what you're looking for is a consolidation here, then some bit of handle. Can you see this looks like a cup, and then eventually a breakout happening. So this particular breakout needs to happen on volume spike. Again, if you look at the volume surge here that Mark Minervini has pointed in his book, this coincides with the buying that is happening here. So there are two things that I see. One, when this particular leg of the cup is forming, what is the volume pattern? And number two, when the breakout happens, this is where I like to enter. Why I'm showing you these textbook patterns? Because you'll see me trading this week based on these patterns alone. So again, this is a variation of cup and handle. So you're getting a beautiful cup here, a consolidation and a breakout. Look at the volume spike here. So this is what you need to go behind. When the breakout is happening, that has to be accompanied by volumes. I don't care whether it is a matured market, whether it is a market where stocks are looking tired. The breakout candle needs to have substantially higher volumes. The second pattern I trade, and again, this is not a Mark Minervini pattern, this is a classic technical analysis pattern. It is a flag pattern. A flag pattern means there is already an existing trend in place, price goes into consolidation, and then a breakout. So you've got to understand what is happening when that pattern is playing out. In this phase, people are getting frustrated. In this phase, the consolidation phase that is playing out in the market, people are not seeing profit on their account. And this is a disease that is plaguing a lot of people in the market, that they want to open their app and their portfolio has to be in green, or the recent purchases that they have made, that has to be in the green. So all the weaker hands, by weaker hands today I define as those people who do not have the patience to even hold on to a stock for 20 days. Yes, majority of people are like this. So the weaker hands are exiting here, while professional people are waiting patiently for this candle to play out. Because when this candle plays out, professional people are not buying here, they buy it here. And by the time the majority of people are frustrated, professionals get in here. And what happens to those people who are frustrated and exit their positions here? When this candle plays out, they already think stock has run up a lot. And again, then they start looking for different stocks. So this is what majority of participants do. So if you look at the next chart, this is a contraction pattern, VCP pattern, which is Mark Minervini's pattern. Again, the concept is the same. A strong stage structure, that is a strong trending market, then a consolidation and a breakout. He's writing, I'm buying here. Look at the volume spike, right? Now, next structure, again, multiple contractions playing out. Keep these patterns handy. Just take a screenshot, because when I start sharing the examples, you'll be amazed out of how these patterns repeat even on smaller time frame charts. Again, when this particular breakout is happening, look at this little spike in volume. It is greater than all the volume action that is played out in the last 20 odd days. This is very similar to Mark Minervini's contraction. You can also see this as cup and handle. All right. So this candle that you see before this hand played out, this is actually a cheat pivot. Cheat pivot means you can take early entry here and then see more gains in your portfolio. One example I'll give you for this week. Again, look at this. When this price spike happened, look at the volume spike. And eventually when the breakout happened, look at the spike in volume. This is telling you that bigger players, institutions, those kind of stronger players in the market are entering. Now I'll take you through some specific examples that played out this particular week. And had you paid attention both in index, both in stocks, you could have benefited a lot. Again, you need to follow the teachings of Mark Minervini, Stan Weinstein, William O'Neill, Richard Wyckoff. These are names I've repeated almost every week, and you should have been able to identify this. First, this is the chart of Nifty, Nifty Bank. Nifty Bank, this I'm seeing on a 15-minute time frame chart. Look what is happening. A beautiful flag structure. Within that, you can see a VCP. I'll expand this chart for you. And then a breakout playing out. Mark out my remarks here. Patterns keep repeating on different time frames. Underlying principles are the same. It's all about patience and nothing else. Within banks, Indus, Axis continue to remain strong. In between, HDFC, SBI are giving good amount of support. IDFC Bank is also exhibiting strong momentum. Currently, it is taking some time off. Trailing in Nifty Bank, that is a futures trade. That's a different topic. But again, which pattern is this? It is a combination of two patterns that played out this week. That is a beautiful flag structure, and then a VCP structure, and then a breakout. Indus, Axis, IDFC. Pay attention to this because I'll share some charts. Axis Bank. Now, when I'm writing Axis Bank is taking leadership here, what do I mean? This is now a daily time frame chart. So this is a flag structure in Axis Bank. And can you see this candle? It is attempting to move above it. See, when an index, when a broader market, any sort of sector you're tracking, look carefully even before when the sector breaks out, which stocks are already breaking out of a particular consolidation region. That can be a flag, that can be a cup and handle, that can be a Minervini contraction. Those stocks which are breaking out earlier, those stocks are actually leaders. Look at the next chart. It is IndusInd Bank. Again, daily time frame. Look at the extension here. Look at the consolidation here. This consolidation has lasted 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days. And then a breakout happened at 1334. And today, I think IndusInd Bank already is about 4% higher from this level. What is this? This is again a classic technical analysis pattern, a flag pattern. If you have the patience to track these patterns, not jump from one day to next to another stock that keeps breaking out, then you will be able to capture these patterns. And look at my arrow. It is again at the volume spike here. In Axis Bank, look at the volume. It is higher than the previous 5 sessions. So this breakout, this was not a clean breakout in Axis. The breakout is still pending, but I hope you get the point. The structure again is really beautiful. So this particular chart that you see, this is actually an expansion of this chart here before the breakout was happening. Again, I explained the concept of cheat pivot. This is not my concept. It's a pattern that is taught by Minervini. So what happens is, this is the previous flag structure in Bank Nifty. Before the breakout happened at 43,989, there was actually an entry available at 0.1, that is at 44,090. This was a cheat pivot. Cheat pivot means you enter into a stock or index before the breakout happens. Yes, it can fail, but in stronger markets, there is higher probability of these patterns working out. So now look at how I'm structuring the trade. There are 2 pivots forming in Nifty Bank. That is number 1 and number 2. Point 1 is a cheat pivot for aggressive traders. Who are aggressive traders? Who are willing to bet a bit early while recognizing the fact that it is not an ideal entry opportunity and the prices can reverse. And point 2 is for risk averse traders. That is traders who want more safety in their portfolio and are willing to sacrifice some bit of initial gains because first the price moves up. Now trade can be structured this way, that 50% you take at 0.1 and remaining 50% you add at 0.2. This is position sizing. Or it can also be structured in such a way that you enter at 0.1 or enter at 0.2 completely, but at any given point in time, it should not cross 1% of your account size. And why I'm suddenly interested in Nifty Bank now and not Nifty? Because it has consolidated for 27 days without falling a lot. A point that I was making yesterday. I'd made a separate post about it. So this I have marked out, 27 days. Now what is the relevance of this? The first slide that we studied. Strong structure, that is strong trending market, then pause, and again a breakout. Let us revise this example again. Strong trending market, it is actually covered by this chart. This is a strong trending market. This is a pause, and then again a breakout playing out. So do I have the breakout chart? No, I don't. But then the breakout happened. I think this was on Wednesday, or Wednesday was a holiday. So Tuesday the breakout happened. And then Nifty Bank, the breakout was at 4490. Today, Nifty Bank is at 44,700. So the point I'm trying to make is that this is how you analyze markets in real time. Trend never goes from 0 to 100 in 2 days. It goes from 0 to 15. It will pause. It will go from 15 to 40. Then it will retest the 15 level. It will then again form a range, again break out, and over a period of time, it goes to 100. Why people cannot write this? Because this volatility that you're seeing from 44,000 to 43,400, then again 44,100, then again 43,400, people are focused on such shorter time frames, open interest base here, open interest base there, all nonsense kind of analysis they do. I'm not calling out people here, but these are technical mistakes that you're making that prevents your account to grow. All this move from March, April, whatever we have captured is without open interest. Why I keep highlighting open interest? Because now again and again I keep repeating this. This is a disease that is spreading across all retail investors and traders. Trade through option charts, trade through open interest, those kind of things. All you need is price, volume, and patterns that have already been taught by so many great traders who have been willing to share information with you. So this frustrating period that you see, in between this period, there are many stocks that are breaking out. So people just rush there and start taking positions. You have to learn the art of selecting stocks and then being patient, then waiting for those opportunities to again play out. And this remark, 27 days Nifty Bank consolidated without falling a lot. This is nothing but what Mark Minervini has given as a guideline, that there is a right time and a wrong time to buy stocks. Stocks with super performance potential are identifiable before they increase dramatically in price. Now, this is an index, so obviously it's not going to fly off. But what he's talking about, a right time to buy and hold, then a right time again to wait patiently, and then a time to buy again. So this is just that concept repeating again and again. Let us now come back to a couple of stocks. This is M&M. M&M, last week itself, I was explaining to you with this slide that, where I started identifying XUV 700, how this stock was setting up, then it gave a pause mode on investments, then again it started setting up. Last week it was at 1373, where it is now. Today it is at 1460. As of now it is at 1450. And again, which pattern it gave today? Can you see this? This is nothing but a VCP, very similar to this pattern. Can you see? And look at the momentum kind of move that played out. And today, 2023, look at the momentum that is coming in. Are you understanding? So these are things that repeat again and again and again. I gave example of, again, M&M, I'll just finish the point here. This is VCP on an hourly time frame chart. Look what M&M is doing on a daily time frame chart. This I've pulled out as of 2:45 p.m. today, Friday. Which is this pattern? Again, we'll go back. This pattern is very similar to this flag here. All right. It's also similar to this flag here. So these are simple things that keep repeating again and again and again. The thing is, do you have the patience to select a stock and then sit with it when it does nothing? It's not easy to hold such structures where stocks are fluctuating from 1420 to 1360. But if you want to catch baggers, multi-baggers in the stock market, it won't happen without you tolerating a 10, 15, 20% move against you. So first the move happens in favor of you. It can move up 20, 30%. Then it will retrace back 15%. If you exit when it is retracing, then you're never going to capture breakouts, never going to capture stocks that fly off. So now comes the important question. There are at least 30 to 50 stocks that give such patterns on any given day. How to select which one to go behind? See, this is one question that is very common. And this is one question that is also asked by traders who are not willing to put in the work. Can I give you answer of this question? Yes, I can. Do I give answer of this question? To a smaller audience to whom I day to day teach whatever structures I'm going behind, whatever trading I'm doing, do I tell them this is the entry point? No. I put out the chart. So if you go back to this post in Nifty Bank here, what am I saying? I'm saying point 1 is the cheat pivot, point 2 is for risk averse traders. I have not written where I am buying because I don't do that. That is spoon feeding, and I don't do this on this channel. I want people who are learning from me to think on their own. If you cannot think on your own, then always you will be needing people to tell you where to buy, where to exit. So when it comes to this, the way I teach things in my smaller community section is that I put out charts. I put out charts of the homework that I do, and then it is up to a particular person who's putting in the number of hours. He will know which are those structures that I will go behind. Because whenever I'm putting out charts, I'm giving out a lot of hints as to whether which chart structure is really good, why there are certain chart structures that work better than others. What is the importance of sister stock movement? What is the importance of tracking strong sector movement? What is the importance of tracking day-to-day candles and the implications of those candles as to how those setups can evolve over time? When you have to go behind risk reward structures, when you have to go behind just structures, leaving risk reward aside. So these are some technical details, and that is why I strongly feel that from whomever you want to learn trading or investing, you need to make sure that the particular trader or that person is then hand holding you for the next 12 months. Hand holding does not mean him sharing, I'm buying here, you buy here. Hand holding means he should be writing what he's thinking and when. Otherwise, your thought process is never going to evolve. And that is why, if you ask my personal opinion, I'm never a big fan of these 1-2 day trading events where there are 10 speakers sharing their strategy. At end of the day, you are left with 10 strategies. Which strategy should you follow? I'm a big fan of something what Mark Minervini does, where he conducts a I think for 5-day event, trading event, and then he gives you access to his Minervini private club or membership, and there he shows you, and the amazing information that he shares, which structures he's going behind and why. That is much more useful as opposed to these even online events that you're attending 1 to 2 day, paying so much of money and then ending up with confusion and nothing else. And that is one of the reasons why I will never be part of any of these conferences or events or whatever happens, because 10 people speaking about a topic, you learn nothing. So my trading has improved because I've focused a lot on very limited patterns, and I've focused on repeating those patterns across time frames. So the Minervini contraction came in post 2013 or 14, I think. That is when I thought that Minervini contraction is actually really good, and in many ways it's better than cup and handle. But earlier it was always a stage breakout, Stan Weinstein stage breakout that I used to trade, a flag structure and cup and handle. So Minervini contraction, Mark has been really kind to share all this with all of us, and that is when I incorporated this in my trading in index futures and in stocks, and it works amazingly well. But the question, do you have the patience and the perseverance to figure out that out of the 30 to 50 stocks that are exhibiting that pattern, how do you choose 3 patterns or 4 patterns out of it? So when I post a chart, I'm going through 50, 60 structures, and then I post only 3 and 4 structures. And out of those 3, 4 structures, I'll select one. That one selection, I never say what it's going to be, because A, it is against regulation. Whatever I'm buying, that is my personal choice. I don't want to disclose, but I do give out a sample as to which structures you should be targeting and why. And that is when you'll start getting better. For you, I will suggest, if you're shortlisting 30 to 40 stocks for yourself, then you got to make detailed notes. And 6 months down the line, come back to those notes and see which stocks have worked and why. That is the only way you are going to learn how to shortlist which stocks are worth it in future when those patterns form. So patterns book can teach you, structures book can teach you, but when you need to go behind those patterns, that is something that comes with experience, and there is no shortcut for it. I will be very frank about this. There is no shortcut. Why you shouldn't have been trading those patterns between November to February, and why you should have been trading those patterns at the end of March and entire April. Again, that is something that comes with experience. There is no set of rules. There is no set of guidelines that will tell you beforehand that yes, this is the time you should be doing that. And I'll tell you a reason behind it. The reason is that every cycle is actually very different in the market. So a cycle that played out last year, June 2022, where I was catching massive breakouts in the market, that cycle was very different from what has actually played out right now. Quite frankly, this cycle I was expecting to come only in August, September later this year, but things started setting up and improving in a span of 10 days. That is between, I'll give you a hint, go back to the charts and see what was happening between 12th of March and 27th of March. There were so many hints that the market was giving between 12th and 27th. And if you look at the list that I've been sharing in the past videos, my first buy-in actually came on 24th March. That is just 1 day prior to when I thought that things were just getting confirmed. And there is no special indicator I have here. It's all due to the teachings of William O'Neill, Stan Weinstein, and later on Mark Minervini. The more number of times you read these books, which I feel are Bible for trading in the stock market, the more easier it will be for you to catch this in future cycles. And market is not going anywhere. Market is here to stay for a long period of time. India is going to grow. India is going to do amazingly well at 19,000. You're seeing this happening, but at 17,000 also that was true. It is just that when that negative news flow is there are all these people who come out and give really stupid interviews saying India economy is going to be doomed, this NPA, that NPA. That is why textbook is different from stock markets, and even experienced eminent economists or analysts, they fail to understand this, because at times with human beings the problem is their ego is bigger than anything that they want to acknowledge, and that is what makes them blind, in seeing what changes are happening in the market. So I hope this was useful for you to at least have the faith of attempting to try this in your own account and get better at it over a period of time. Make sure your comments come in the first 6 hours itself, because then I also like to enjoy my weekend, and I'll certainly answer most of the questions that I can. So now head over to these 2 videos. Invest some time in going through these videos. It's a bit longer video, but go through it, because here Stan Weinstein is speaking about some really detailed concepts that you should all be going through, and a lot of you have already read his book, so you'll get some amazing insights out of his video. So have a great weekend ahead, guys. Take care and be safe.